Yeah, largely expected by a poll of economists that this repo rate will go up by another 75 basis points. So you're looking at a prime rate in the bank at the moment now around about 10.5%. And that, Bradan, is above what we had before the COVID-19 pandemic came in. So, I mean, I'm afraid if you're saving, you're in a good position because your saving interest rate is up. You're owning a car, a house, and you've got repayments on that. It's going to be pretty tight. What's the fundamental reason for this to go up? And you just heard the Reserve Bank governor seconds ago saying you are beginning to see what people call second round of inflation creeping in. So everything is beginning to go up, and especially when you look at that very unexpected 7.6%.
We have to rein in inflation, the future inflation.
Yes. So that's where we stand now. Whether or not we're going to see more of this, I want to bring in Gina Schoeman from Citibank. I'm not quite sure whether or not she's with us this afternoon. Gina, are you there?
I'm here. Hello.
So we look at it largely expected, Gina, 75 basis points on the repo rate. Though it was expected, it's still a very hard pill to swallow if you're a consumer having a home loan or a car loan or anything close to that, is it?
It's always hard for the consumer because it typically happens at the same time where inflation is high. And that's why consumers with the high inflation are typically demanding higher wages to try to compensate for that. But it's exactly what you and your colleague were saying earlier. This is the South Africa Reserve Bank trying its best to control for future inflation. Because believe me, if you think the inflation rises we've seen so far this year are painful for consumer incomes, just wait and see what it would look like if the SARB did not control for inflation, because in that space you would have inflation expectations rising even higher, which sends a signal for second round effects into the economy. And then of course we have seen this in the past. We're quite lucky to only have inflation peaking at 7.8%. Previously in South Africa we've seen peaks of inflation well in double digits, and it's been detrimental to economic growth. And I think that's where it's so difficult maybe for consumers to actually understand that I know it's painful if you have debts, but what the South Africa Reserve Bank is trying to do is to act now to control for inflation, because inflation hurts your income and therefore it hurts GDP growth. But if they don't do so, inflation gets even more out of control and then it has to hike even higher.
And it's interesting, Gina Schoeman, that the Reserve Bank Governor, Lesetja Kganyago, pointing out to that stubborn component of the inflation. I mean, we've got food inflation that ordinarily one would assume would start to ease. It's not easing, and he's pointed that out pretty clearly in today's address.
Yes, absolutely. And it's always part of not just the commodity price story. So what is wheat doing? What is maize doing? Which ironically in South Africa, we've never had as better maize crops so consistently one year after the other. But unfortunately within this, if you have a look at what the governor was saying, there's still a lot of FX risk built into the concerns around inflation, which is ultimately rand dollar. And we have seen huge volatility as of late, mostly because of the global environment. So the US Fed, the more they hike, the more emerging market currencies are going to weaken. And as a result, we're always the one that seems to weaken sometimes the most. And that always puts pressure on our economy instantaneously. Fuel prices will go up, and food prices are, of course, then anything that's imported and anything linked to export parity prices, even if we are growing a lot of maize, is unfortunately going to come back and hit us. So it's those components. We always call it the day-to-day components or the fuel pump experience of consumers that then leads them to expect inflation expectations to go higher. And they then themselves ask for higher wages, and it becomes very self-fulfilling off the back of that.
The worrying thing is, when you look at this repo rate and interest rate, Gina, is that we're now effectively higher on the repo rate than we were before COVID-19. So we had 7% on the repo rate, 10.5% on prime. One wonders if this is going to sort of ease anytime soon. Do you think the next rate hike, if it does happen, would be a softer one?
Yes, that is our expectation. But let me also just add that we might be higher now than we were, or just only higher than we were pre-COVID. But think how much higher inflation is at the moment than where we were pre-COVID. And that, again, is something that is utterly detrimental to GDP growth in South Africa, particularly to the consumer, and within that, particularly low-income consumers that depend so desperately on their income with very little job security and quite a lot of unsecured debt, which makes it very expensive to service. We are expecting a slightly softer trajectory from here on. And that is based on the fact that from the time we hit March next year, you must remember that's when the Russia-Ukraine war broke out this year. So the base effect for that is going to mean that a lower oil price is going to send inflation down quite quickly. And this is why in the SARS forecast, they might have a slightly higher inflation trajectory right now. But by the end of next year, we're heading towards that 4.5% midpoint target again, so long as they continue to tackle inflation. And so right now in our baseline forecast, we've actually got only another 25 basis point hike priced in for the first quarter of next year. However, keeping in mind things are highly data dependent, as the governor reminded us, the risk is that instead of 25, it is more likely to be up rather than down. So if not 25 and we're wrong, then it could be 50 followed by another 25. That would put us quite a lot then above pre-COVID levels. And as soon as the Fed hits its recession and potentially starts cutting rates, I'm pretty sure South Africans will start having a conversation about whether we could potentially reduce rates.
And as I let you go, Gina Schoeman, I mean, one of the things highlighted by the governor this afternoon is this dark cloud over the security of electricity. So he says, and I mean, he's mentioned it in some shape or form, that power cuts have had a definitive effect. In fact, the fourth-term growth targets look a bit more subdued compared to what they had. So going forward, this economy, as echoed by the Reserve Bank governor, is pretty reliant on what would happen with the problems at Eskom, because it has a direct effect on how this economy grows.
Absolutely. And ironically, as you said that, we hit load shedding in the office, which is why I have less light on my face. But it's exactly that. You know, load shedding is obviously detrimental to growth. And one would think that low growth means you shouldn't be hiking rates as much. But if you look at how much load shedding has meant that our retailers, our producers, you know, all of our big corporates in South Africa have had to lean heavily into diesel in order to keep the lights on and to keep everything working, that diesel cost, it has to go somewhere. It can't go into their margins, otherwise they won't be profitable. So ultimately, it could be passed on. And if it's passed on, it becomes inflationary on top of what's already inflationary through electricity tariffs, where we're not actually getting the efficiencies of a better performance. So yes, load shedding for the next 5 years, as Eskom has reminded us, is going to be something that is going to be front and center of monetary policy decisions.